So what I want to do is take a look, bring this sort of full circle back in terms of tax planning. Now, as David said, we have a diversified portfolio currently made up 57% of publicly traded assets in fixed income, alternative strategies, and public equities, but 43% in private. Now, I'm just going to focus on the private side for this part of the discussion. So that's what the private side looks like. You've got fixed income and mortgages and private debt, then you've got real estate and private equity, infrastructure on the other side. All of the income on the mortgages and the private debt is fully taxable at maximum rates. So ideally, they'll be held by entities that don't pay tax, like registered funds and foundations, for example. And the rest of it would be taxed differently. Now, for many of you, if not most of you, you either have a holding company or an operating company. So we're going to take a look at what happens if we were to put the non-interest-bearing investments into a corporate environment. So let's imagine this is for the last 5 years. So on a weighted basis, if we started with $1 million, today the market value would be roughly $1,658,000. The gain would be $658,000. The taxable income is about a quarter of that, a little less. The amount of tax paid in a corporation over the last 5 years would have been $10,000 over the 5 years. So the net return was 10.7% is the gross return, net of fees roughly 9.7%, net of fees and taxes 9.6%. So how is this? Is this sort of some magic that we've come up with, or are we diddling CRA? I mean, how did we actually pull this off? There are some logical explanations behind it. First off, in a company, you can earn refundable tax credits that you cannot earn individually. So that gives the advantage to corporate investing, notwithstanding how people have looked at tax reform. There's a low turnover of assets, which means you get long-term deferred gains. When we buy real estate, for example, it is not our intention to sell it or trade it. Depreciation, especially obviously on real estate, makes a big difference because it reduces taxable income from rents and changes rents into what's called return of capital, and return of capital is not taxable at all. And then planning fees that we charge are deductible. That's the only nice thing about the fees that we charge you is that they're tax deductible, so I just wanted to mention that. So let's look at the fixed income side. So we have private debt and we have mortgages, our private assets that are fixed income. We mentioned lower risk, shorter duration, higher liquidity, taxable income. And the returns are lower, quite a bit lower than you would get with private equity for all of these reasons. But part of that reason is that we're in a low-rate environment. And the question we should look at is, well, how low is that rate environment? Because it could last for a while. This is an interesting chart, very difficult to read. And all these countries on this left side are developed nations around the world. And on the top is the interest rate they're charging on their bonds from 3 months on that side to 30 years on the other side. Everything in blue is a negative interest rate. So what do we mean by a negative interest rate? It's simple. You can buy that bond as long as you don't mind paying the issuer of that bond a certain amount of money every year, because they're not going to pay you any. And when we're talking about it, there's a lineup to buy these bonds. So the rationale behind this is really challenging. My favorite example is Switzerland, which we've used before, but it's just continued to get worse and worse. So as of roughly yesterday, let's imagine you convert into $1 million Swiss francs, which is roughly about $1.3 million or 4 Canadian, and you decide to buy a 10-year government Swiss bond. So the deal that they say to you is, okay, ignoring any fees we're going to charge you for holding your money or anything like that, the interest and we're going to pay you as follows. We're not going to pay you any interest for 10 years. When you come back in 10 years and ask for your money back, we're going to give it to you. But unfortunately, only 921,000 Swiss francs. So you're going to take an $80,000 haircut. So you're going to leave your money there for 10 years, knowing on a guaranteed basis you're going to get 80,000 less francs. So those francs better appreciate a lot over that next 10 years for this to make any sense. And that's the world of sovereign bonds. So let's take a look at this again. We blend the fixed income with the equity, the real estate, the infrastructure. So now we have a balanced private portfolio, just private in this case. Starting capital 5 years ago was $1 million. The return, about $1.6 million. The gains, $600,000. The taxable income, lower, because of course we've got protection with the registered accounts. And how much tax was paid in this environment? No tax for the last 5 years. So we have now a return of 9.6% before fees, 8.6% after fees, and 8.6% per year after taxes. So again, looking at how is this possible? Well, obviously we didn't pay tax on the registered returns. Other private assets have low tax turnover, as we talked about earlier. The portfolio is now balanced with private assets. And in addition to all of this portfolio still generates a 4% cash income from the variety of sources that are being earned, especially on the real estate and on the private debt. So, I know this. This obviously is the major topic of the day, the coronavirus, which effectively is or could be a global crisis, and in return, of course, has created incredible turmoil in the markets. And that is the definition of a crisis. And of course, we sort of have this understanding. I mean, obviously, I don't speak Mandarin, and I've always had this understanding. Crisis is, really, a Chinese word, and if you break it apart, it really stands for two things. It stands for danger, but also opportunity. And that was a quote used in a speech by John Kennedy back in 1959. I thought I might want to fact check that, and I did, and I found out that, okay, the story's a little bit different than that. As it turns out, and I'm just going to read this, therefore it could be somewhat misleading and biased to translate in the context of the word weiji to opportunity instead of a changing point or a confidential event. So the issue for me is that this is actually more interesting. Are we at a changing point? There's less money available in public markets. There's a lot greater volatility, not risk, volatility with publicly traded markets. Because in the end of the day, the markets are an auction where a lot of people get together, and if they get nervous about something or euphoric about something, things rise or fall way beyond their intrinsic value. That tends to happen much, much less in non-liquid or private markets. So we looked at public versus private, but it's not versus, it's and instead. We have to deal with this tax reality, and we've talked a little bit about some things, portfolio design, that would make a difference. So the things to think about, the lessons to learn from this include the following. Okay, first off, as David said, planning is the priority. So even before any thought about what your asset allocation should be, what is your portfolio design, along with what is the financial planning that you need to make it effective? You need to diversify. You need cash flow from your portfolio, which is a really great way to insure against volatility. Private does not necessarily mean higher risk, but it does absolutely mean less liquidity. And how much of your returns are taxable? Knowing that, and that's something that we try to measure for you all the time to try to make it as efficient as possible. And finally, what can you do about that? And on terms of the tax issues and stuff like that, like I said, we'll regroup for breakfast sometime in the next couple of months, and we'll have some thoughts about how to do that. So with that, we're finished our formal remarks tonight. I want to thank you all for coming. We're going to stick around for some Q&A, but we're going to take a 5-minute break. So for those who would like to get refreshments of wine or food, please do so. And again, many thanks for coming tonight. Thank you.